We've been saying you're watching the wrong end of the yield curve and pay attention to the short end, the 2 year treasury note and into the bills, because not only has that been where all the supply has been over the last 4 months or so, and the amount of supply in bills is truly astronomical, but the supply has been easily absorbed by the marketplace. You look at bill yields, they've been actually stable, and in recent days, they've been declining a little bit. And that's the same as the front end of the yield curve, the 2 year treasury. Just Thursday, for example, another sell off in the long end of the curve where the 10-year treasury yield went up about 9 basis points or so on the day. The 2 year treasury actually lowered by 5. And that continued into Friday, where 2 year rates were down substantially. And of course, long end rates came down a little bit. But we keep seeing this dichotomy. The front end of the yield curve is doing something very different from the back end. And that's sending us a very important message about fundamental characteristics of the economy, risks there too, as well as maybe some collateral messages as well. But as far as the economy goes, the Federal Reserve has said we're not worried about anything, except that's what they say in their words. But when you look a little bit behind their words, there's something else going on, because more and more we're hearing about the Fed pause extending to November, maybe even December. And some strategists are now saying the Federal Reserve might actually be done for the entire cycle. Steve, Mr. Van Meter, got a lot to unpack here. We got the difference that, again, we said this a couple of weeks ago. We've said this quite a lot. Watch the front end of the yield curve, not the long end. And now we've got Federal Reserve officials that sound confident, but it's not what you say, it's what you might actually do.
Yeah, that's right, Jeff. Because if these central bankers actually thought the U.S. economy was going to resurge and we're going to have even higher inflation, then they should just be talking about, hey, we're just going to keep raising rates. In fact, we're so confident, you should just keep expecting us to raise rates because, well, of course, that's all they can do. But we're not hearing that now. It's almost as if they're taking a step back, looking around the world and starting to wonder if maybe some of the things we're seeing out of China and out of Europe, now even out of Canada, that maybe that there's a lag effect to coming to America. And one thing that they've wanted, and we know that Powell's eagerly and desperately wanted to see the long end of the curve rise. He just kept pounding on the drum until everybody responded. They've driven long rates up. And it's like, as soon as that went up, all of a sudden they're all like holding their breath going like, uh-oh, like, what does this mean? And, when central bankers start to panic, Jeff, that's never a good sign.
And that's kind of what the market's been waiting for. And I think that's part of the 2 years steadiness. The front end of the yield curve is steadiness, because what the market up there is saying is that we still expect that to happen. We're just not sure when or how long or how much. We're still looking around the world as central bankers are, and we're looking at the same things now, because you listen to Jay Powell. He had a speech just on Thursday where he referenced what seemed like the perfect possible scenario. Here's what he said. To date, declining inflation has not come at the cost of meaningfully higher unemployment, a highly welcome development, but a historically unusual one. It's that last little phrase he threw in there, which I think explains the pause more than anything, because as you always say, Steve, they're always looking backwards. They're always looking at these lags. And what he's afraid of is that this will not be historically unusual going forward, and that eventually we will see all of the negative signs in the economic statistics that we've been waiting for, that the market has been pricing. And so the Fed pause is, we've been lucky so far, but will our luck actually start to run out? And when you look at the marketplace, you look at some of the statistics, as you just mentioned, around the rest of the world, especially, maybe the luck already ran out and the message is taking a while to get to the Fed and to the U.S. government numbers.
Yeah, Jeff, it's like we're at the monetary casino here, and the Fed is, continuing to roll the dice, and they keep hitting the number, right? We've raised rates; it hasn't gone bad, but now they're getting to the point where it's like, wait a minute, if the U.S. labor market goes, and they've been so lucky that initial claims remain as low as they have been, but it's almost just like you said, they're getting nervous now, like, because we know that once initial claims start to rise, they don't generally stop. Now, we did get that. We got a pullback on them, and they're still historically low. But there's a big bet here. It's like, how many more times do you want to roll the dice? Or do you want to start pulling your chips off the table? What you're seeing is Powell and the other speakers are starting to pull their chips back and hoping that things don't unravel because they know what they're going to have to do, and that's cut rates, and they don't really want to do that yet.
Well, part of what Powell said and what he actually didn't say in his words and what in his speech was that he recognizes the non-linearity to all of this. He's saying that, okay, you stretch it a little bit and nothing happens and you're okay. You stretch it a little bit more, nothing happens and you're okay. But you stretch it too far, it's not like it starts to slowly turn negative. You stretch it too far like a rubber band, it just snaps. And so what they're really afraid of is that final stretch where maybe the economy is a little bit weaker than they thought, especially when you consider the context of the global system. Maybe the monetary system isn't as resilient as they keep claiming. We see all sorts of indications suggesting that it's not. Rising US dollar exchange value is a crucial one and a very easy one to follow. Even a central banker realizes when the dollar goes up, that's not a good sign. So I think Powell and who was it? Christopher Waller came out recently, said, we can wait and see how the economy evolves. That's what they're really concerned about. They got the markets saying, we're still thinking that eventually this nonlinear negative process shows up. And Federal Reserve officials are now saying, we're not so certain that that's not the case because we're really in historic territory here. And history shows, as we've been saying for how long, Steve, there are no soft landings.
None. In fact, and I don't know if it was Waller that said this, Jeff, because there's so many Fed speakers like every day. It's like every hour we have to hear from him again. I mean, I don't know why, but I believe he was the one, and you can correct me if I'm wrong, that said he's like, hey, I'm noticing stress in the small businesses in my area. And he's like, boy, that really makes me kind of nervous here that maybe we've gone too far. And that's just central bankers speak for, we don't want to keep hiking to immediately cut because it says we were wrong. But if we pause and nothing breaks for a while, right, the Jenga tower, the example we use, it still stays there. But if it goes for a few months and then it topples, well, it couldn't have been us because we didn't do it. So they're being very careful here. It's almost like they realize that, hey, we're at an inflection point here. Anything, maybe what's going on in Israel could have some knock-on effects to the U.S. economy. They're acting. I don't know which regional Fed came out with a report saying, look, there's no big deal with the student loan repayments. It didn't have any effect on anything. It's like, yeah, okay. Like, let's give it a couple months and see. I think they're really nervous here, and they just don't want to look wrong because they always look wrong. And that's the problem, is they've got to clean up their image. If they can engineer the soft landing, which we know they won't, but if they can get this thing to stretch out for a few months with a pause and then fall apart, I think they come out a little bit of a winner here.
Yeah, there are tremendous amounts of risk all over the place, including, as you just mentioned, oil prices and energy prices, which just add to an already tenuous situation to begin with. And you have to believe that's part of the conversation going on, not just in the halls of the Federal Reserve, but all around pretty much everywhere else, the marketplace too. I think that's why you're seeing the markets reacted the way they are. The sell-off in the long end is taking everyone's attention, but it's really, again, the short end, all the factors that would apply to the long end, pushing it up, the inflation risk, higher for longer, all of that stuff, they would apply as much to the 2-year as it would the 10-year. But here's the 2-year again. And it goes back to early July. The 2-year seems like there's like a magnet or something. The 5% yield or the 5% limit, it seems to be a limit or an attractor or something where as soon as the 2-year gets a little bit farther above 5% into the 520s, it goes right back down. And the same thing on the other side, when it got into the 490s and 480s there, it go right back up. For some reason, people like the 2-year treasury at 5%. And that tells you something, not just about what Jay Powell's thinking or what he might be thinking in the future. It also, more importantly, says what the risks are to the monetary system and the real economy in between now and whenever it is that we know the soft landing finally gets the soft landing narrative finally gets dead and buried.
Yeah, and Jeff, I want to come back to your comment about the dollar rising and that being a bad thing, and it really is. And I don't think a lot of people understand that, because what do we keep hearing about? The global manufacturing sector is kind of in the toilet, but everyone's like, well, look at the U.S. and how great it is. It's like, well, why don't you wait a while and see what the strong dollar does to the U.S. manufacturing sector? Because it's not going to be friendly and it's not going to be nice. And the dollar's on a tear. In fact, that's kind of why I'm at the U.S. Treasury today. In case you were wondering, there's a global dollar shortage, as you obviously obviously know. I'm just trying to get some or find some. And that's what the dollar is telling us here. And a lot of people just don't understand that there is a global dollar shortage. You look at what's going on with China's property developers. What do you hear them saying? Well, we can't pay on our dollar denominated loans. Not our yuan dollar denominated loans. We're good there. It's our dollar denominated loans. So you start looking at, the yield curve. You start looking at, like you said, the 2-year. You look at the dollar rising, and you kind of start mixing this in a bowl a little bit. You're like, this is not a good recipe.
Yeah, it's one of those things where, in a dollar shortage, where do you go? I guess this is sort of a last resort. You could try the mint, but as we know, they don't have any useful euro dollars there either. Maybe you can find some specie and some cash that would, I don't know, maybe fill a couple of pallets that you can ship over to China. I'm sure they would pay you a pretty yuan for it. But it's fun, that's the point though, is that we see all of these symptoms from all over the place. It's not just about Evergrande or Country Garden or whatever the other one that's, these pleasant sounding, it's like real estate developments or something. These Chinese real estate developers all have these really nice names. And you're right, Steve, they're defaulting on their dollar debts because, as we know, dollars are very hard to come by. And as we also know, the Chinese have been struggling very, very badly to try to maintain the yuan's exchange value to the US dollar for these reasons. In fact, they've been selling their reserves again, which is not a good sign for either China's situation or the situation in the global monetary system. If countries have to sell their reserves, it's because there's not enough funding available to just maintain the same level of activity that they need to maintain. And China is a big one, as we all know, but it's not just China. We saw the same thing happen in India. So you have the two most populous countries on earth, two of the largest economies on earth, and both of those economies are doing the same thing at the same time for the same reasons. And they're likely some of the reasons why Jay Powell is now saying, we're not sure about rate hikes.
It's just adding to the narrative is like something in the global economy somewhere is going to break. I have a hunch that it's going to be outside the U.S. first because, there's just no incentive for money to move outside the U.S. right now. But when we look at the money curves. Well, why does a 2-year keep telling us is whatever the Fed is telling you, we don't believe it. We kind of believe it, but we're not buying 100% in. In fact, we're leaning toward the downside a little bit. Not like what we heard from Bostic today saying, hey, I think I will support a rate hike in late 2024. It's like, hey, pal, by late 2024, there can be nothing to hike. You're going to be cutting. So you're going to be at zero probably by then. And you're going to wonder if you're ever going to get off of it.
Yeah, that's a key point too. Again, for those of us who are inside the United States, we have this very different view of the global conditions because it's not always the same, or it's not always as obvious as it is outside the U.S. inside. The dollar is a perfect example. We don't really see the dollar and its behavior, nor do we connect it to the consequences of the dollar and its behavior because we don't ever. It doesn't impact our daily existence. Where you better believe it's a big, not just a topic of discussion, but also a big impact on just the economy's ability to operate at its whatever level it needs to operate at. And as we go through all of these increasing problems, that's another point. It's not like things are getting better, not like we're seeing a whole lot of improvement. We're seeing the opposite. We're seeing more and more warning signs that are captured in one snapshot by the rising dollar exchange value, but that's representative of a lot of other issues that, as Steve, you're just saying, they're interrupting the flows of money and credit throughout the global system. Again, we don't necessarily feel that here in the United States, but they feel it big time around the rest of the world. And as that creates problems for them, it will create more problems for us. Getting back to Powell and the FOMC one more time, they even mentioned this back in 2019. And we talked about this before. In 2019, when the Fed cut its rates when it was supposed to be hiking that year, they mentioned, by the way, the economy looks a lot worse outside the U.S. So maybe we should be careful here and start cutting rates just in case all of this outside stuff happens to blow back on the U.S., which of course it was already doing at that time. But even the Federal Reserve realized that we aren't on an island, that the U.S. is not some lone station all by its lonesome out there in the world. Everything is connected. What we don't know is exactly how and to what degree those connections will be Big problems, little problems. Will it be tomorrow? Will it be next year? And getting back to Powell's statement about nonlinearity, if the avalanche starts to go down the hill, it goes really quickly once it gets up enough speed.
Yeah, and Jeff Powell's he's got what, high interest rates, high oil prices, inverted yield curves, inverted money curves, dollar shortage. I mean, rising dollar. I mean, there's so much stress on the system right now that you should not have all of those things happening at once. I think eventually, if the pandemic money is really what's been keeping the U.S. economy going, and if it's not that, it's the banks still extending credit on revolving debt. One of these two things comes to an end, and maybe both of them do. And I think we heard from Bostic, I think today, say that I don't see the U.S. economy hitting a wall and the data coming crashing in. It's like, no, we're going to see it. We just don't know when, and when we do, it's way too late.
Well, he has to have been. I mean, all of these Fed people are talking to the banks anyway. And as we know, ever since August, banks have been building and piling up their cash cushions. They have been borrowing funds in every market they can potentially find. They are building up defensive measures for something. They're not just doing it because they feel like it. I mean, banks are in the business to re-lend funds, not to build it up and have it sit idle on their balance sheet, especially when the opportunity cost is as high as it is now. So the banking system itself is telling the Fed or you and me and anybody else in between, we're not liking what we're seeing here either. And it's just one more thing to add on top to everything else. Steve, one more thought here. The real economy. Again, what we've seen and what we've heard from you and elsewhere in the services part of the economy is that maybe there has been an impact from oil prices, gasoline, as well as student loans and everything else. The labor market. Yes, jobless claims were low, but we've seen labor statistics that suggest the labor market has slowed down materially. What's your view on the services side of the economy?
From what I'm seeing here in my own backyard, Jeff, the services sector is slowing down far more rapidly than anyone anticipated. And that's not a good sign when you're a place that functions largely on the services sector. I mean, right now, it's like I can get into popular restaurants without having a reservation at near peak hours. I can get into parks without a whole lot of crowds. I mean, it's not exactly what you want to see, because when I talk to the workers, the first thing that they tell me they're looking for, more hours.
Maybe that's the answer. The reason the Fed is pausing is because Jay Powell has no trouble getting a dinner reservation. There are a ton more videos on the Eurodollar system and its struggles, including one that's linked below me. As always, I thank you very much for joining me here. Huge thank you, Eurodollar University subscribers, as well as our Eurodollar University members, some of whom you see right here. And until next time, take care.